Hello and welcome, everyone. My name is Kyle, and welcome to the simple webinar on private markets, where we'll be looking at the modern family office approach to private markets. We're going to be having a fantastic conversation with an esteemed group of colleagues. So on the line, they'll be joining us shortly. If you have any questions, obviously throughout this hour-long webinar, feel free to include them in the chat. But let's get started. Perfect. So we have Brett Mock on the line from Nasdaq Private Markets. We have Pete Clancey from Canoe Intelligence, and we have David Ryan from Zeal Partners. We're going to be spending the next hour together unpacking the sort of the modern family office's approach to private markets. This is the simple family office webinar. My name is Kyle. I work at BCG, but let's get started and do a little bit of an introduction to everyone on the call. So perhaps we'll start with you, Brett. It'd be great to know a little bit about you, your background, which organization you're from, and your relevance to the conversation today.
Yeah, thanks, Kyle. Hi, good morning or afternoon to everyone. I've been in capital markets for about 30 years, mostly working for bulge bracket banks. After the financial crisis, I was lucky enough to be the national chairman of the Security Traders Association. Spent a lot of time with the SEC and Congress, basically convincing them that the equity markets were not broken. It was the OTC markets, but it got me really involved with market policy, regulation, and infrastructure. And as I progressed in my career, I realized that the private market was not a small market anymore. So I am head of global capital markets for Nasdaq Private Market, and I helped spin Nasdaq Private Market out of Nasdaq, our former parent company. We took on outside investments from a number of banks, including Goldman Sachs, Morgan Stanley, Citibank, Allen & Company, BNP, UBS, and Wells Fargo. And we are building critical infrastructure for this asset class. And we are also the largest player for liquidity solutions for companies, private companies in the space.
Fantastic. So definitely an expert in this space. Perhaps over to you, Pete. I'd love to know a little bit about who you are, which organization it is that you're sort of going to be representing today, and what your role and relevance for the conversation is.
Yeah, absolutely. And thanks for hosting. Really appreciate it. So again, my name is Pete Clancey. I lead Canoe's family office business. Previously spent time on BlackRock's family office team out in San Francisco. I was also at another startup previously working with family offices and other allocators on portfolio construction analytics, commitment pacing, liquidity modeling, so doing all with alts, but on the front office side. So a little bit about Canoe. We're the market leader for post-investment document management. We work with over 300 institutions, asset servicers, wealth managers, and family offices. This includes over 80 family offices. So we use our machine learning powered solution to really quickly, accurately, and securely collect information across all private market investments. And then we deliver that information via API to downstream applications. So a little bit about what we do, but I'm sure we'll get into it a bit more.
Fantastic. So again, another person who's obviously been deep in the trenches of both the sort of family office space as well as the sort of private market space. Over to you, David.
Thanks very much, Kyle. So I'm David Ryan. Work as part of Zeal Partners, which is a London-based corporate finance boutique focused on private markets. Two main areas: secondary trading of growth tech names. Certainly, activities picking up more recently, with publics doing much more after somewhat of a hiatus for the last couple of years. And then we also raise money on growth names that broadly fit into a couple of areas. One being decarbonisation, includes such things as climate tech and also carbon funds, or a carbon fund, and then we also increasingly focused on the AI space, both raising primary capital for funds and back into we're working on a secondary trading opportunities in that space as well.
Fantastic. Definitely sort of super relevant areas today, particularly sort of AI as well. Be a bit of a topic we'll pick up at the end of the chat. So sort of diving straight into it, and maybe I'll sort of start with yourself, Pete, is, pretty straightforward, simple question, but why are private markets so key for family offices?
Yeah, I mean, this is a conversation that could probably take an hour, but at a high level, I mean, the private asset classes, PE, venture, private credit provide really attractive return profiles. I mean, everyone knows that at this point, and we're in a new regime where public market return profiles will likely be muted, which is why we're seeing a lot of investors increasing their allocation to alternatives, and we're seeing this across institutions, allocators, being family offices, and of course retail. Retail is starting to gain access as well. And really, if you think about it for family offices, it's really the perfect asset class. Family offices typically have extremely long time horizons, and they're very well positioned to capture the illiquidity premium.
Excellent. And I guess if we begin to think about, this space has rapidly been evolving, and it continues to do so, particularly now. David, it'd be interesting for you to think about how and why this space is evolving in the way it is at the moment.
Well, I think it's interesting evolution. The last couple of years, as I said, it's been a bit of a hiatus in private markets, and I think very simple. A couple of factors. Came down dramatically after a period of overinvestment through COVID. And then as a result, the private market allocations as a percentage of portfolio weights increased substantially. So it was a very difficult period up until Q4 last year. That has changed very quickly. Obviously, public markets have come back. There's still a bit of an overhang from overinvestment. So I don't think private assets have really rallied nearly as much, but perhaps with the IPO market opening again, that will change quickly. But I think another interesting consideration is DPI from private equity funds. It's at a pretty constant 2 or 3 year fundraising cycle for the bigger platforms, and I think DPI ground to a halt. It's very challenged. And so that represents, presents itself as a very difficult fundraising environment, even with the big tentpole private equity managers who are kind of look to, got budgets, vast fundraising budgets on an annual basis. I spoke to the chairman of a $200 billion asset manager, private markets asset manager yesterday, based out of Europe. They've got a budget to raise $20 billion annually. They fell well short of that last year for the first time in a number of years. So I think that will be enduring at the fund level, at the growth tech names in certain areas. I think the markets will come back quite quickly.
Interesting, great. And Brett, I suppose if we think about what this might mean for family offices, and how they should be thinking about sort of shifting their approaches.
Yeah, I mean, I agree with what Pete said, that this is an asset class that's perfect for family offices. In fact, we see the participation rates from family offices only increasing. They're long-term holders. That's typically what a company wants. The last 2 years have been difficult. I'm not gonna lie. The market froze up, and because companies are private, they can basically restrict the transfer of shares or outright block the transfer of shares. We saw that a lot last year, where they just didn't like the price because they didn't want to affect their valuation, and that's their right as a private company. That to me is an inefficient market, frankly. But if you look at the broader, I'll just throw some numbers at you. I mean, the average time that a company IPOs has doubled in 10 years. So it used to be 7, now it's 14 years before that company IPOs. Most of the alpha has been realized by that IPO event, and so for the J curve crowd and those that want to have outsized returns in alpha, it's the mid to later stage privates, and that's forced, frankly, the asset management community, the public side, to cross over because they're just weren't getting the gains anymore. This is probably, we estimate by 2030, a $9 trillion asset class. It's about 3 today. There's still about 1,000 private companies that are, a unicorn. Issuers use, equity and grants as part of their compensation for employees. We estimate there's about $1 trillion worth of that. We've worked with over 650 companies over the last 10 years and done over $50 billion. Work with 200,000 individual employees and C-suites. So it's not a small asset class. It's about the size of the United States municipal bond market. The problem is it's still emerging. It's still an emerging market.
Yeah.
I could go on and on and on, but I'll stop.
Excellent.
Yeah. No, I'm sorry. I was going to.
Go ahead.
I was just going to jump in there and actually kind of link back to the question you asked before about the space evolving rapidly. I think another key driver is just the access and options available for family offices. So like there's platforms like Case, iCapital that are making investing into alternatives significantly easier and more accessible. So they're bringing down the barrier of entry, especially for smaller and more emerging family offices. And then also, I think from my time at BlackRock, asset managers are super focused on family offices. They're a great partner. So there are a lot more solutions that are being made available from some of these larger asset managers out there. And then with that, the profile of the family office is really expanding. The number of family offices globally, I don't know the exact numbers, but I know it's exploding. There's a huge driver there. There's candidly more wealth at the top. But yeah, the barrier of entry is just lower for families to actually assemble a family office. It now makes, you can do it with less AUM now, based on some of the technology that's available.
Yeah. And I guess sort of to your point around, the sort of shape and form of family offices changing and evolving quite quickly. Whether it's a traditional family office or a next-gen family office, and how they're thinking about sort of future-proofing their approach to private markets, and ultimately the tools they need to sort of bolster that sort of data and market intelligence. How do you think family offices should be thinking about that, Pete?
Yeah, another big question. So I don't meet any family offices that are projecting their commitments to go down over time. They're all seeing a significant growth rate across new managers, existing managers, and groups should be focused on building an operational infrastructure that can really scale with their commitments. It's critical, otherwise it's going to become a significant burden on these firms or on these family offices. With more volume and documents and data, speed, accuracy, transparency will be absolutely critical for these groups. I think up until today, investors in private markets and vendors alike have been focused on creating efficiencies around managing data required for accounting, performance, tax workflows. So this includes like creating efficiencies around valuation statements, transaction notices, K1s. But now with the influx of exposure to private funds is the need to understand underlying exposure, understanding actually what you own. If you're 60% allocated to the private markets, for most groups, you're just seeing the fund company or you're seeing the fund. You're not actually looking at the underlying investments. So for example, like having rapid transparency into underlying holdings will tell investment teams that they might have a significant exposure to Stripe across multiple managers. And we're actually just releasing a product right now that does this and seeing significant traction among allocators, and including, of course, family offices.
Interesting. So you're saying Excel spreadsheets and PDFs are no longer fit for purpose?
I don't think so.
Okay,
I can add on to that. I think Pete and I are aligned on that. I think transparency only makes markets better, right? And this is not a transparent marketplace, and it's obviously doesn't have the regulations. We have built an entire operating system that basically can take analog to digital. So the transfer of documents, the movement of money, the tax reporting, the settlement of a transaction. We also believe in, again, price transparency to frankly allow both buyers and sellers to have a visibility into what the fair value or the price is. It's a fragmented market. We settle transactions for many private companies. We're the exclusive settlement transaction, and we can see that there's a lot of price disparity even in the same time period, and it's because people don't have an accurate view into what the price is. We purchased 15,000 COIs from the state of Delaware and scrub that from analog to digital so that people can now look at the price per share in the last round valuation. I know there's PitchBook out there and other products, but we also find that you need source of truth. So we are using regulatory filings, our own 10 years of historical data, and then when the company allows it, trade history and triangulating that price product and that data product, which we actually are going to release this quarter to the institutional community.
Fantastic. Well, yeah, I guess we'll dive a little bit deeper into the sort of solutions available on the market and obviously how they are and should be evolving. But thinking a little bit about, taking it back to a family office perspective, where are we starting to see some strategic risks potentially emerging for family offices? And maybe this is a question for you, David. As these risks begin to evolve, what does that mean for family offices?
Sorry, just on mute. Well, sure. I think liquidities, in this space is clearly the number one risk, and you might get 8% public equities, 12 to 12+% in private equity / venture. Liquidity is the number 1, 2, and 3 factor, I think, for many people, and I think. We're in the decarbonization space as well, and I think climate risk is becoming, within one's investments, within the portfolio, is becoming a bigger consideration. And I think this is also becoming pronounced because climate change, we're sort of off track as it relates to the UN pathway, so that's for sure. The other thing within the family office space is the huge sort of transition. Inheritance transition in the family office space, and so the younger generation, the generational wealth transfer leaves the younger generation much more focused on climate change. So I think that's a good thing for assets that can deliver those objectives, but it also has an implication for liquidity. Are some of the bigger private market platforms delivering on the generational shift in climate-related objectives? Jury's out on that one. And with those objectives in mind, there will be more liquid assets that are more volatile in the target range for many of the younger generation. So I think that's a consideration.
Yeah, perfect. And I think very much leading back to, I think it was Pete, you were speaking a little bit about this idea of transparency. Actually beginning to think about are the data sets and the availability of solutions in the market providing the right level of transparency for family offices so that they are able to prepare for future regulatory risks or requirements around ESG or climate commitments within their portfolios. So I guess a question for you, Pete, is thinking about what role can and should technology solutions play to begin to kind of prepare family offices for some of these struggles that they're facing.
Yeah, absolutely. I mean, and you're right. I mean, the lack of visibility across a portfolio for a family office is a significant challenge, significant burden. And it's not just, it's from actually collecting the data that's required for that to visualizing that. And oftentimes that's multiple applications that need to talk to each other. So yeah, that's a significant burden, especially again as allocations to the private markets increase. So yeah, in terms of the role that technology can play in plugging those gaps, technology can allow family offices to stay lean while really increasing their operational efficiency and relieving some of that burden of managing documents, collecting documents from portals, extracting data from those documents, getting into downstream systems. So technology and in that context, Canoe can really help with that. And then allow investment teams to manage investments, the portfolio, and deploy capital as effectively as possible. So solutions, automation solutions can just make that the collection of data, the visualization of that data just a lot faster, so investment teams can make faster and better decisions. And what I think David was talking about is this: there's a liquidity challenge right now in the market. We're seeing cash positions get a little bit lower. Managing capital calls is just becoming more of a burden, more of a challenge for family offices as their cash balances are lower. They have more commitments that are coming in on a regular basis. So having that rapid transparency into upcoming capital calls is really, really critical.
And maybe I'll sort of point the question at you as well, Brett, around this idea of thinking a little bit about, what role can and should technology be playing to kind of do some of the heavy lifting that family office traditionally had done, but now they're needing to kind of sprint a little bit faster, be a little bit smarter as the market begins to change.
Sorry.
Yeah, over to you.
Yeah, I mean, the good news is that it is changing, and it's going to continue to increase. So let's just start about like the barrier to entry. Like you have, a private company, friends of Elon, and there's a handful of people that are invited to a transaction, and it's a closed transaction. So the idea that like we, our DNA and NPM, Nasdaq Private Market, is really to service the issuer, because our goal is to hand them off some data to our parent company, Nasdaq, or our former parent company, so they can actually do an IPO. So one of the things that we've done is rapidly expanded our network of global investors, including family offices, so that they can actually be eligible to participate in private companies. We ran a number of programs last year, and we're active right now with the top AI companies, for instance, as an emerging asset class. So it's access to more opportunities that typically was either run by a company or a bank, and the family office network, a lot of them just didn't get exposure to that. Number one. Number two, it's information, it's portfolio tools, and one of the things that our clients have asked us for is like, we need to mark our portfolio to market. How do we get an accurate price to report? And if you look at the mutual fund filings, they have to have a pricing committee. So we are going to give the institutional, including the family office community, a Nasdaq Private Market price. So you can have a third party that can do that. We have portfolio tools that you could put a portfolio in or a watch list in, and you can look for the price of that portfolio or names you care about, and also have potentially liquidity in those names. Just to sidetrack, I think the one of the biggest risks, frankly, is the fact that even the VC community is facing this. Is you had basically a 10-year up and to the right marketplace, and the last 2 years, there's not been very many exits, and I increasingly get asked about, from VCs included, how do we exit a position because they need to return LP capital because that vintage fund is at the end of its life. Some funds are doing continuation funds, some are doing 40 Act, but the idea is that you don't want to buy an asset and then not have a strategy for the exit at some point. And I think that's another structural problem in this market, because companies can basically block that.
Right. So I guess if we're thinking very much, again, back to David's point around liquidity, what type of solutions should family offices be beginning to think about to support understanding how to navigate this challenge that they're facing? David, over to you. No worries.
Off mute again. Well, look, a decade ago, maybe 5 years ago, private markets were sort of quite the domain of the institutional investor, and family offices. This is a very broad-reaching statement. Were somewhat newer, more fund-driven, less single, assets. No, very little exposure to single names, and I think that's evolved markedly. But on the other side, for liquidity, the big platforms in secondary investment, whether it's Ardian or Lexington or HarborVest, etc. I think we all know the names. They've been much more proactive in the family office space, providing liquidity across a broader range of assets. 10 years ago, it was a KKR fund or a CVC fund, and anything sort of off the reservation was probably a bit more challenging. Now I spoke to one of those big platforms a few weeks ago about a VC portfolio in Bangladesh. So I think that they're sort of going out the risk and liquidity curve, but that also provides support for the family office community who are doing more in alternates, both at the fund level, asset class level, and the single name level. So I think the market's sort of coming up to meet that challenge.
Fantastic. And I guess maybe Pete, over to you. So thinking a little bit about, what kind of solutions should a family office begin to think about, and why?
Yeah. Obviously, I'm going to say managing post-investment documents. It's an easy one. So yeah. I think I always talk about when I talk to groups. When we talk about creating automation with an organization, I always talk about and discuss it's important to think about automating what you should automate. Not everything should be automated at the end of the day. So I think what we do is we really automate like the really mundane stuff, the easy stuff of collecting documents from portals. So managing passwords, two-factor authentication. No one wants to do that job. So we're automating that component of the process. We are automating the extraction of data points from documents using machine learning. We have a lot of technology when it comes to validating data points that we're extracting, but that's where a user would potentially get involved. And so we don't want to entirely automate that part of the workflow. So, and then automating the delivery of data. So I think, yeah, especially with post-investment document management, we're seeing groups that even have 100 commitments, having having a full-time employee just managing post-investment docs. That's significant. That's a lot of overhead. That's also a job that really no one wants to do, to be candid. I think there's that. There's also performance and exposure reporting. I think that's an easy one. Going back, I've already mentioned this a couple of times, being able to look across your entire portfolio to understand exposure and performance is absolutely critical for groups right now, both for the investment team and the ops team.
Right. And I guess maybe a similar question for yourself, Brett. So if I think of a typical family office today, obviously that automation process of trying to ensure that they're streamlined and fit for purpose for tomorrow, and the sort of tailwinds that are facing them. But what type of solutions can they use to augment their current capabilities? Anything that comes to mind?
Yeah, not everything should be automated. I agree with that statement. Smart people should need to still make decisions as fiduciaries. But the pain points and the friction that exist in this asset class almost make it, for many, just another barrier to entry. It's too much work, too manual, takes too long. If I look at, I'm just going to cherry pick a couple of examples because this is a common theme. A lot of the management community don't love secondary investing because the time that they have to spend to uncover the opportunity, run past an IC committee, do the diligence, and then that opportunity might not be there. And then the company itself might block the transaction. You're talking about 1, 2, 3 months of a process, and sitting on cash is not an efficient way to make investments. So when we start settling transactions, which again sounds boring, but it's literally the movement of documents and money, which is what exchanges kind of do actually. The settlement period drops from like 90 days to 5 to 10. And that actually really matters because that means you have certainty of a transaction and the movement of and change of ownership and movement of funds. So that's one example. More access to information, which we've already talked about. It's just being able to accurately price the asset and having access to information, or if there's no information that's being provided in the transaction, being able to go do your own research and diligence to find it. And I think that that's another struggle that a lot of investors have, in family offices especially, because if you're not in a data room with a company, how do you know what that company's actually worth and what the cap table looks like, what their financials look like, et cetera. So, and unfortunately, this market, it's a private market. Companies do not have to share information. So we also think that the future will be sort of bifurcated, meaning that there'll be more regularity amongst company liquidity, once a year, twice a year, and hopefully more of an open auction where there's access points for family offices and other investors, or just a continuous market. The more liquid names, trade, more regularly. And that allows for more regular participation with more opinions.
All right. So great. maybe stepping back a little bit from solutions, or thinking about what's in the market, and this is more a question for you, David. So if I'm thinking of a family office today that's operating quite a lot within the private market space, what are some of the common pitfalls that are increasing risk or exposure, ultimately to things that I might not have intended to have exposure to? What are the things that you're sort of seeing or hearing in the space?
I think probably some of the things I mentioned, liquidity is one, but it's improving. As I also said, we're involved in secondary market trading, and Brett's the expert in this market, but and certainly platforms like NPM and others are really improving visibility on market levels and providing liquidity, and so I think all that's headed in the right direction. I think there is in some sectors, I think there is a developing trend for companies to provide less information, which is really quite remarkable. Doing in a secondary in one AI situation at the moment, the company is providing zero information on financials or actually anything. There seems to be no shortage of investors coming to invest in that situation, which surprises me. But there is, in some of the more so-called headline attractive names in certain sectors, there's more interest in family offices, but less information, even though liquidity is starting to improve. And I think many entering this market find it really unusual and very difficult to get their heads around. So that's something I would highlight, and I think that's something that people are surprised about. But I can't really add much more than that, other than what's been discussed already.
Great, fair enough. Well, again, I think if we begin to think a little bit about, I'm a family office today, and I'm thinking about, what might the best practices be for selecting, comparing, and ultimately managing solutions. So Pete, I might sort of start with you here. If I'm thinking of being a family office and I'm thinking about how to discover, which solutions are available in the market, and how do I ultimately begin to compare those solutions?
Yeah. I mean, first off, organizations or databases like Simple, it's a fantastic resource. But I think the other big thing is just to ask your peers. If you're a family office, you obviously know other groups that look like you. Ask them what they use. And then I also think groups should really leverage vendor relationships. If you think about it, vendors are, not all, but a lot of vendors have a great view across the entire ecosystem and know which solutions out there are good ones, they're quality solutions, and maybe the ones to avoid. I think also integrations between systems is extremely important right now, and will continue to be. So understand, like talking to a vendor that you work with and understanding like how they might integrate with another system that you're considering is very critical.
Fantastic. And I guess, Brett, so if I think of, thinking a little bit about how I know I can trust a solution as I'm beginning to, warm up to the concept of using it. So maybe it's the first time I'm beginning to think about adopting a solution like yours. How do you kind of know you can trust it? What kind of should make you feel at ease, and what might be a red flag?
Maybe I'll start with the fact that even though this is a less regulated market, we're still heavily regulated. We have to file with the SEC on almost everything and FINRA exams and all that stuff. So we operate, as a registered, marketplace under SEC and FINRA. We also, have kind of requirements, that when we work with companies. I would like to probably see some more. I hate to say this because I feel like everyone's too regulated, but I would like to see some more transparency overall, because if you look at some of the failures like FTX and Theranos, and even WeWork, frankly, I think that these hot names, and then if there's not some sort of regular disclosure and regular access to information, you have a risk that these companies can like those examples can be a real problem. And so I think it starts there. And again, just to be clear, I'm not asking for more regulation, but I am saying I think there does need to be some standards so that it's fair for investors to appropriately look at opportunities. And again, for us, we are. I mean, my board of directors are the biggest banks in the world and one of the largest exchanges. So I think for us, trust is literally the most important thing. Period. And that's what our brand means, is a trusted market. And we look at the landscape and see a lot of less than worthy or less trusted marketplaces, or frankly just bulletin boards. And I think that as this asset class needs to mature, it does need to kind of transition into a more trusted market, trusted parties. And again, it just needs to grow. And I think it's a global product. So I think that's also not just specific to the United States. And one of the things that probably excites me the most is the opportunity to help create emerging markets in other economies and other countries, to allow for that sort of VC-backed company to emerge. So I do think that the future is bright. And we're going to get to the future later, but I think it's really important for trust of a marketplace with standards and transparency.
Great. And maybe a follow-up question to you as well, just around this question of moving beyond trust, thinking about family offices. The world's a volatile place, and ultimately we know family offices should always be prioritizing their cybersecurity. What type of things should they be looking at in terms of understanding whether the data that they're ultimately accessing or sharing is secure, and that they're in a good place?
And that was for me.
That's for you.
Yeah. Well, I sit in California, so obviously we have our own state data policies. But I agree that cybersecurity and data is super important. A lot of private issuers basically view the data as theirs, and that's fair because it's their company. But once you transact in markets or with other counterparties, if you look at exchanges or different marketplaces, that price and that information does need to somehow create transparency. For us, just speaking specifically, I mean, I feel like we're very fortunate because our entire infrastructure backend sits at Nasdaq, which is one of the global exchanges. So for us on a cybersecurity and trusted market, as we're talking about, we sit within the Nasdaq's ecosystem. But I think that especially when you're talking about legal documents, name disclosure. I mean, when you work in capital markets, you always protect the identity of counterparties. And I think one of the things that I think surprised me about this marketplace was because it's more like a transfer of a title of a house. You've got a trilateral exchange of information. You've got a seller, a buyer, and the company, which means everybody knows who everybody is. So again, we've done some things in our market to separate signature pages and just sort of try to create more confidentiality. If this market can move to even an escrow model or other things in the future, you might even get to a place where you can be totally anonymous, but the company still, at the end of the day, has to know who is transferring ownership. SPVs are a product, I think, that a lot of global investors use as well, because then you don't have that same friction point of a company getting involved, and you're basically just bundled into a vehicle. The transparency of SPVs is something we're actually working on. We think that the price transparency of SPVs needs to improve because, frankly, there's a lot of hidden costs, and we are going to help change that in the very near future to create more SPV products, or help create more SPV products, which might be attractive for family offices because you just basically can buy into an SPV. So that's another thing I think that's important there.
Right. So I guess maybe a similar question over to you, Pete, is thinking a little bit about, ultimately why having visibility and traceability of your sort of documentation is so important for families, particularly in a sort of global context. Particularly family offices these days, might have multiple family office locations, West Coast, Singapore, etc. So why is it so important to ensure that there's kind of security with how that data is managed.
Yeah, no, I mean, it's incredibly important for a variety of reasons. I mean, I think nowadays it's the risk of breaches, the risk of hackers is really significant. For a lot of, and I mean, as groups continue to work with more and more vendors, there's just going to be more risk. So having a real policy, having a true diligence process and how you evaluate vendors is going to be critical.
Great, perfect. That's something we'll be picking up in our next webinar. So I'll sort of leave the pin there for people to tune into next time. But perhaps thinking a little bit about, and this is a question for you, David, and I'll pass it on to you, Pete, as well afterwards. But thinking a little bit about, the sort of cost benefit of beginning to actually adopt private market solutions. So why should family offices begin to think about optimizing, their approach to private market solutions?
Well, public equities 8, private markets 12. Risk, and on a risk-adjusted basis, if you do it properly, there's a lot of returns to be had, or alpha, as Brett said, going a bit early. So the return opportunity is there, and it's been proven. And so I think they're to do so, but for all the reasons, whether it's data, transparency, liquidity, ability to analyze situations, get information, all of the things we've been discussing about today, is more challenging. So you've got to build a focused team to be able to execute successfully for you.
Right.
So that would be how I would think about it.
And I guess this similar question to you, Pete. So if I'm thinking about building out a team internally or trying to sort of optimize, the cost that it takes to bring this team to life, how should I be thinking about doing that when it comes to adopting solutions?
Yeah, I mean, every family office is obviously different. There are a lot of shapes and sizes out there. I mean, I think it's tough to think about ROI when evaluating a single vendor or single solution. It could be tough to draw direct conclusions, but I mean, lots of vendors have ROI studies out there. So, I mean, family offices can leverage those. For example, like we typically see a 90% reduction of the time spent processing post-investment documents. But I always like to point out in my conversations that it's not strictly about cost savings. It's really about creating a more robust process, accessing more data, eliminating key man risk. I think that's a big one, especially as family offices really do have lean teams. If one person leaves in a 3-person group, that's significant. So I think there's also just eliminating human error risk. That's if you leverage technology to process documents and data, you might employ smart people, but like humans are humans, they're gonna make mistakes. Technology doesn't make mistakes. So yeah, hopefully that's
perfect. And I think so. Say I'm a family office and I'm thinking about pulling the trigger and committing to a particular solution. And again, this is more a question for you, Pete, and maybe for you, Brett, as well. But what does onboarding typically look like? Obviously, it can vary product to product, solution to solution. But just trying to manage a bit of a family office expectations. Is this going to be a super disruptive process to my workflow and my team? Do they have to change the way they operate?
Yeah, I mean, every onboarding is different. So I think you have to. I think you have to evaluate the actual solution, what you're solving for, to really truly grasp what you're going to be undertaking. I think it's also really. I mean, you can always, and this is coming from. I'm a salesperson saying this. Like, don't just listen to me. Talk to your peers, right? Yeah. Talk to another family office that has onboarded the solution and ask them how it went. Like, what types of resources do you actually have to allocate to the process? How long did it take? Did you actually reach your goals? So I think because there are so many different types of family offices out there, lean on your peers. Talk to groups that look like you about their specific onboarding experience.
And sometimes I guess it's just about asking the question: is what does this process look like? What can I expect? What the requirements?
Yeah, and vendors and Canoe, like, well, I mean, we're going to give a very like descriptive. We're going to give you the information on what is required, what you need, what you need to be successful, the time commitment. But again, it's always helpful to talk to your peers as well, in addition to the references that we or another vendor might give.
Great. Well, we've got a good question in the chat from Karen Roscoe, which I'd love to just sort of perhaps bounce around the group a bit. So, short of regulation for more transparency in private markets, what can a family office do to get private companies and or funds to provide the data and information that they need? Perhaps one for you. I'll start with you, Brett, and then I'll sort of ping it over to you, David.
Yeah, I mean, that's a great question. That's really honestly one of the best questions you could ask, right? I mean, if you're a fiduciary and you're an investor, I mean, you would want to think that you could have access to management information to make that investment. I mean, that seems pretty obvious, but again, private companies don't have to share. That's their right as being a private unlisted company. So the answer is that you need to be able to participate more in company programs where the company does provide information through a data room or access to management, which we actually, as I was saying earlier, we actually think that's one of the ways this market's really going to evolve, is just a more regular cycle of company liquidity programs. And the companies have some pressure, just so you know. It's not just like, hey, it's my information and I'll give it to you when I want. Employee retention is a big deal, right? I mean, if you're, especially a tech company, you need to keep your key employees. And if they can walk across the street to a public listed company like an Amazon or a Google, you have to be able to give them options and give them liquidity for their compensation and their equity. And so there is pressure on companies to provide solutions for their employees so that they can actually have those liquidity options. And typically, the companies want to have the right investors in their cap table, which includes family offices, because again, they're long-term usually investors. So there's an incentive for them to share information and do that. We run, I think for WeWork, we ran like 8,000 employees. I mean, it's like, we can scale this market very easily and through, company solutions. And it can be, early to mid or late stage company. We talk about, tenders and buybacks in the kind of earlier stage. You can talk about more price discovery, sort of mid-stage, and like we did for Coinbase into a direct listing, we ran a dual-sided market so that you can actually have companies being at arm's length from picking the price. I think there's a conflict a bit too when a company dictates a floor or they dictate what the price is that even their own employees can sell at. It really should be, frankly, something that employees can actually and influence the price so they can put floors. But anyways, my answer is that the company has to be incentivized is really, frankly, the best answer I can give you. And they should be, because, again, of the employee retention problem.
And there might be sort of over to you, David, similar sort of question, but I guess if we're beginning to think a little bit more about the space that you are increasingly operating within, which is obviously the climate tech and sort of ultimately in natural capital space, are you seeing there an appetite for private companies to begin to share increased type of data? How do you get that type of data out of companies if you're wanting to get these type of disclosures?
Unfortunately, Kyle, it really depends a little bit on the sector at the moment. As I said before, the hot companies are providing very little information, and some of those clearly in the AI space, which is a sector that don't need to tell anyone is white hot right now. Climate's interesting. I like that sector in the respect that there's a more collegial attitude. We're all in it together. We're going to save the planet. And so, I find the companies in that sector are much more open. And let's face it, in the last couple of years, there's been a lot of money that's gone into climate tech VC, and that was one area that really held up in the sell-off through 2022 and 23. There's still continued. I think it slowed down a bit last year, but in 2022 it was quite robust. So Yeah, look, I think it's really a function of how hot the sector is, but I see that changing.
Yeah. I mean, I guess
so what the cost is.
it entirely depends on the incentive. Very much sort of back to Brett's point. So I guess thinking a little bit more about the future and where private markets are going. We obviously have 10 minutes. So obviously some more questions open to the floor. If there's some of the audience who'd like to ask us some questions, but otherwise, if we begin to think a little bit about private markets and ultimately the implications of AI. So AI is already beginning to change some of the solutions we're seeing in this space. Brett, it might be interesting to hear how you're thinking AI might actually begin to kind of disrupt the intelligence space within these markets. What are you sort of seeing? What are you anticipating? What is exciting you? Over to you.
Well, to David's point, I mean, I think AI just as an asset class or as a sector or industry group is white hot. I mean, I think $15 billion was raised last year amongst just a handful of AI companies. We're active with AI companies ourselves. As far as a solution for investors and family offices, I mean, yeah, I think back to Pete's point, you can't have tech doesn't make mistakes. Humans do, but you still have to be a fiduciary, right? You still have to make decisions. So AI, using AI as a tool to scrub documents, to find critical information. I mean, who has dug through the Edgar filing system of the SEC, or who's dug through COIs and from documents incorporated from the state of Delaware, or just who has many logins to many different data providers and having to manage all that, and like how do you aggregate that data? I mean, we're going to release our API product this year so that people can consume data the way they want to, not force them to have to do it through another front end, although we have that too. So yeah, I think AI absolutely is going to help, especially probably smaller teams scale themselves, because they'll be able to use that product and look for information they need.
All right.
Yeah,
go ahead.
I could just add on to that. So yeah, I think sorry, I just had a coughing fit.
Right.
Bad timing. So yeah, I think when done correctly, I think ML and or AI will allow product and companies to really scale significantly and become real players. I think we'll probably see existing technologies or solutions out there rapidly bring more product to market. That's really driven by machine learning, but also I think there'll be a lot of new companies as well that are going to emerge built on ML or AI technology. You can obviously do a lot more. You can be a very lean team and bring product to market if you're correctly leveraging ML. But I also want to say that I think AI and ML is thrown around a lot. I think a lot of companies now just say like, oh yeah, we're using it. Yeah, it's a thing. It's part of our product. I don't think that's very true. I think I think individuals can leverage ChatGPT and start using it, but for a company to actually wrap it into a product and make it consumable by their clients or by their customers, I think that's tough. So I also I would ask the right questions. I would really uncover how groups are really actually leveraging AI or technology to, in our case, extract data or collect documents.
Right. Perfect. David, it might be interesting to get your point of view on this, as I know you're quite close to the sector as well.
Well, yeah, I think Peter's right. I think it's a bit like .com in the 90s, right? All of a sudden, every company was .com something. And now everyone's utilizing AI. I think it was a survey. It may be dated now. 3 months is a long time in this market, but I think there was some survey I saw that 92% of companies surveyed were planning to plan or develop AI enablement between in the normal business activities, but only 6% had actually done so. Now maybe that number is sort of 85 and 15 now, but there's still a big gap. Now, are the AI companies going to benefit the most, or is it the regular companies optimizing their operations for AI and therefore increasing their productivity and profitability. And I kind of think that's where a lot of the value is going to be driven. Now, we're clearly, are we in a bubble? I don't, as we saw, I guess ChatGPT is a year and a bit old, but almost a year and a half old now. So I think we've seen bubbles can carry on for a lot longer. It's certainly pretty frothy. But I think that the valuation or the fever pitch is going to develop, but more move to more regular companies that are at the front of AI utilization and implementation, rather than the AI companies themselves.
Right. Yeah. I mean, I see that very much on a day-to-day basis as well. So we build quite a few AI products, and really what we're seeing is, companies are very much in the early stages of beginning to understand what the implications and where the potential use cases are. Are they getting the proof points they need to be able to scale out these solutions? The question is still there. Is the impact being delivered? I think we're still going to see a couple more years of us needing to investigate how far AI can actually go to sort of serve ultimately users' needs and market value. So I think we'll still see a couple more years of sort of needing to prove market value. But beginning to think a little bit, I suppose, beyond AI, which is obviously the frothy topic, which I think will increasingly be so for a while, thinking a little bit more, and David, I might sort of point this back at you. We're sort of increasingly seeing this demand for ESG mandates changing and shifting. We're beginning to see a little bit more sort of geopolitical tension. I can mention multiple scenarios where this is playing out, increased volatility. Ultimately, what does that mean for private markets, and why does that mean that they're potentially more important than ever?
Great question. Well, I think there's a few themes. We had the ESG bubble that's well and truly gone, and we had the war in Ukraine, and that allowed some of the fossil fuel companies to take sustainability off the front page of their annual reports for a period. I think that will come back. It's interesting that oil prices went up and the oil stocks also went up, but there wasn't that much of a dramatic re-rating multiple-wise. So they got a pretty good trade where they could buy huge amounts of their own stock back for a kind of a 18 to 20% return on capital. That was pretty much the best thing they could do. But I think they probably got a bit of a free pass with the war in Ukraine. I think that'll probably come to an end soon. But in private markets, as mentioned earlier, there's been a big growth in climate tech VC, but a lot of these companies are very early still. I don't see any climate tech VC companies probably making the grade for an IPO in the next year or two. Not a negative thing. It's just that they're earlier in their path. Helpfully, family offices are engaged. There's generational wealth transfer I mentioned, but also the Magnificent Seven are also very active investing in the space, and certainly in some of the climate solutions, they're really investing uneconomically. So, for example, the Frontier group of companies, including one of your competitors, Kyle and McKinsey, they're very active investing in direct air capture. Dare I say the name?
Yeah.
Microsoft, Stripe, so on. They're investing in direct air capture, where the price for carbon removal is sort of, who knows, $800 a ton. There's a 500 million-year-old technology called a tree, and you can invest in that to remove carbon for $5 a ton, which is good for the technology companies. But it shows that there is a commitment, across a range of investors, including corporates, to advance, help advance and scale technologies in that space. Perhaps the oil companies or the fossil fuel companies will catch up again.
Excellent. Well, unfortunately, we are at time. So it has been a fantastic conversation. If you would like to connect with any of the individuals you see on screen, we've obviously got Pete from Canoe Intelligence. We have Brett from Nasdaq Private Markets, and we have David from Zeal Partners. You can find them all on LinkedIn. Otherwise, you can join the Simple community, which allows you access and ultimately more conversations, insights, fantastic media to join with like-minded individuals like the ones you've seen today. This webinar sort of highlights a intelligence report which Simple will be releasing within the next week. So keep an eye out for that on the private markets, and otherwise catch you soon on LinkedIn. Thank you so much, gentlemen. It's been an absolute pleasure as always. Chat soon.